The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Nuances of Death Benefit Accelerations. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber. Welcome, everybody. I'm glad you joined me here for today's webinar dealing with life policy accelerations. We're going to spend some time talking about the common types of life policy accelerations today. We're going to talk about some of the tax nuances associated with those. But before we do, let me remind you that every month we put on this webinar. It is free of charge. It is freely accessible to those in the financial services industry. So if you feel that you know someone who would benefit from hearing about the topics that we cover, feel welcome to invite them to join us for the webinar. In July, we'll be talking about the trustee's obligation to irrevocable life insurance trust beneficiaries. For those of you who aren't going to be on vacation during the week of the 4th of July, we are going to be holding the webinar on July 5th. And for those of you who are on vacation, feel welcome to check the recording on our YouTube channel. We'll talk a little bit about more about that at the end of today's webinar. But if you can't join us on July 5th, feel welcome to visit the recording on YouTube. Again, before we get started, let's figure out what we're going to talk about in August. Our three choices for August are first, truthing the stretch, which will discuss the new stretch rules as a result of the Secure Act and some of the nuances that have been worked out by the IRS's proposed regulations. The second choice is STOLI, stranger-owned life insurance gets spicy. And the third choice is using UTMA, the Uniform Transfers to Minors Act, and some of the nuances associated with that. What I want to do is I want to open up the poll and ask each of you to go ahead and vote. I'm going to give you about 15 seconds to make your choices. If you haven't yet voted and want to vote, please go ahead and get your vote in. All right, we're going to go ahead and close the poll. And the topic for August will be truthing the stretch. So please make plans to join us for that session. So let's go ahead and talk about life policy accelerations and what it is that we're going to discuss today. We're going to talk primarily about terminal illness accelerations and chronic illness acceleration features that are built into certain kinds of life insurance policies. We'll talk briefly about biannual settlements as well. What we won't talk about today is other kinds of accelerations that may be available for certain kinds of life policies from certain companies. Terminal illness and chronic illness, based on what we're seeing at Advanced Underwriting Consultants, are the most common kinds of accelerations. And from our perspective, the rules about their taxation are fairly clear, built right into Code Section 101G. And so that's what we're going to talk about. So let's spend a little bit of time on those topics. Let's talk specifically about terminal illness. And let's talk specifically about what the definition of terminal illness is in section 101G. And you can see the words here. This is quoted directly from Code Section 101G. A terminally ill individual means somebody who's been certified by a physician as having an illness or physical condition that can reasonably be expected to result in their death in 2 years or less after the date of certification. And so certification by a physician is necessary. Life expectancy, according to that physician, needs to be 2 years or less. If that person checks those boxes, then they are considered to be terminally ill. And if there is a feature in the life policy that allows for an acceleration of the death benefit for terminal illness, that death benefit will be income tax free under Code Section 101G. One of the questions that Jennifer and I sometimes get here at Advanced Underwriting Consultants is what happens if the person who is terminally ill actually lives longer than 2 years? Well, from our perspective, first of all, that's a good thing. But secondly, there's no requirement that the person actually pass within 2 years, just that a physician certify that they're unlikely to live longer than 2 years. And so that's the key. And if they meet that definition, then the benefit will be tax-free. Those of you who are life insurance producers, which are probably most everybody on this call, you know that if you are working with a company that provides for an acceleration on account of terminal illness, usually the insurance company will discount the death benefit to some extent due to the fact that the proceeds are being taken early. The amount of the discounting will depend in part on how early the death benefit is being accessed. And so that's usually what happens. And by the way, if it's a life settlement company that provides the acceleration for a terminally ill person, that's also income tax free. The person's got to meet the same definition, certified by a doctor as having a life expectancy of less than 2 years. But if that happens, then a viatical settlement will also be tax-free, be treated as a tax-free death benefit. Let's talk about chronic illness. Chronic illness is a little bit more nuanced in its definition. It's also in Code Section 101G. And by the way, Code Section 101 is the code section that says the death benefit of a life insurance policy is income tax free. So Code Section 101G says that, for these situations, we're going to pretend that the benefit that you receive from a life insurance policy is a tax-free death benefit. That's the deal. And so Code Section 101G goes on to define what a chronically ill individual is. It's that person's been certified by a licensed healthcare practitioner, doesn't necessarily have to be a doctor, as being able to, not being able to do 2 out of 6 activities of daily living, ADLs, for a period of at least 90 days due to a loss of functional capacity. And then the other chronic illness definition is requiring substantial supervision due to a severe cognitive impairment. That covers severe, Alzheimer or dementia situations commonly. Cognitive impairment is another potential trigger for chronic illness. The activities of daily living are the same kinds of ADLs that are built into standalone long-term care products: eating, toileting, transferring, bathing, dressing, and continence. If you've got somebody who's been unable to do 2 of those for at least 90 days, they would meet the definition of chronic illness under the tax code. We often get asked how much of a benefit under the chronic illness acceleration feature would be tax-free. Carriers are kind of all over the place on how much they will allow a chronically ill individual to accelerate the death benefit under their product? And the answer is under the tax code, you can get, if you're chronically ill, $420 per day or actual amounts paid for qualified long-term care services. Whichever of those is greater is tax-free. And the code makes clear that you don't actually have to get paid benefits if you choose the per diem of $420 a day. It's just that whatever you get periodically without regard to expenses incurred, you can get that and work out the equivalent. $420 per day works out to just over $150,000 per year. And so if somebody accelerates a part of the death benefit in a given year of $150,000, even if they have no amounts paid for actual qualified long-term care services, under this definition, that amount would be tax-free because it's within the per diem limit. One special rule with regard to chronic illness is that if we've got a business-owned life policy, Code Section 101G5 specifically says that when a business receives a chronic illness acceleration, it is not treated as a tax-free death benefit. It's taxed like a normal distribution from a life insurance policy. So a recovery of basis first, taxable as ordinary income once basis has been recovered. And so that's important to know. We've certainly heard of situations where clients are trying to use business-owned life insurance with chronic illness acceleration features as part of their buy-sell funding, making a buy-sell trigger in the buy-sell agreement for chronic illness. And so the parties need to be aware if that kind of situation is structured as an entity purchase with business-owned life insurance, that the benefit paid to the business for chronic illness, the chronic illness acceleration will be taxable, and so the parties need to think about that. We don't have perfect information about what happens if we've got personal third-party ownership. For example, if we've got an adult kid who owns a policy on the life of the insured, if the adult kid chooses to accelerate the death benefit in the event the insured can no longer do 2 out of 6 ADLs, is the benefit payable to the adult kid who owns the policy income tax free? The answer is we don't know for sure. Seems likely that it would be, but we don't know the answer to that for sure. And so if you're working with clients who are in that circumstance, I think it's important to let them know there's a little bit of uncertainty there. We also get asked questions about what about ILIT ownership? Does it make sense in an ILIT situation to sell the chronic illness acceleration feature? And I think it's incumbent on all of us to be a little bit careful about that. With an irrevocable life insurance trust, if we've drafted it the right way, we've not given the insured any right to reach in and pull out money from the ILIT, because if we did give the insured that right, it would screw up the estate tax objective of an irrevocable life insurance trust. And so while there's nothing inherently wrong with the trustee of an irrevocable life insurance trust getting at the death benefit early if the insured is chronically ill, what the trustee is typically not allowed to do is send the money back to the insured. And so you got to be careful about how it is that you sell chronic illness benefits in connection with ILITs, because there is no direct line back to the insured. And so you've got to be a little bit circumspect about how it is that you explain that to your client. So there we go. So as I mentioned earlier, we're not going to talk about other types of life policy accelerations. I recognize that there are some. Critical illness, for example, is one such thing. They're governed by different code sections and different rules, and the carriers are a little bit inconsistent about how they deal with those circumstances. And so it's less standard. That's why we're not going to talk about them today. What I do want to touch base on before we finish up is the tax reporting associated with accelerations. The IRS expects the life insurance company to produce Form 1099-LTC if there's been an acceleration from a life policy for either chronic illness or terminal illness. And I'd like to point out at least a few parts of this form so that you've seen it and have some ability to tell your client about it first. First of all, the full amount of accelerated benefits paid are reported on the form for a particular year. And so if at the end of the day, the carrier is paying out more than say 150 grand, the IRS will at least be put on notice that they might be able to challenge the excess as being taxable if the client can't prove that they have actual long-term care expenses of more than 150 grand, right? The carrier is expected to check either that the accelerated amount is per diem or reimbursed, and in most cases, the per diem box is going to be checked. And like I said, that will put the IRS on notice that that perhaps the amount ought to be challenged if they choose to do so. In addition to that, there are places on the form for noting the difference between the policy holder and the insured. And so if the IRS ever gets it into its mind that this is a business-owned acceleration and ought to be taxable, or that it's personal third-party ownership and perhaps may be taxable, they will have the ammunition they need from Form 1099 LTC to be able to make that challenge. And so Jennifer and I often get asked, well, how is the IRS going to ever find out about these things? This is how the IRS is going to find out about accelerations, and they've got a fair amount of information on this form so that if someone, if the IRS feels like someone is unfairly claiming a tax-free benefit, they do have at least some evidence to start the challenge if they're so inclined. So what are the takeaways that we'd like you to take from today's webinar? First of all, the life insurance industry, I think, has done a good thing. They've made hybrid life policies available that offer death benefit acceleration features to policy owners, and these death benefit acceleration features are actually pretty useful. Congress and the president apparently agreed. They've decided that such products should be blessed with positive income tax attributes. And it feels to me like we're going to see more and more of these chronic illness acceleration features on life policies because it feels like the pool of companies offering standalone long-term care coverage continues to dwindle. The premiums for such policies where they are available seem to be very high. And so it will be, I think, more attractive to our clients as we move forward that they're going to buy life policies with acceleration features, even though those coverages aren't directly comparable. A lot of people will kind of see life insurance as a way to at least partly cover the risk associated with the possibility of terminal illness or chronic illness. And we'll see it as an alternative to standalone long-term care policies. The tax rules for chronic illness and terminal illness are fairly clear. If we're in a circumstance where the company doesn't allow for terminal illness acceleration, life settlement may be an option for certain of our clients. And you know, this is a good thing. I alluded to it at the start of this summary. As life insurance professionals, I think we can feel proud about being able to offer product alternatives and useful information to our clients who are worried as they get older about the effects of aging and accompanying illness. So at this point, I'd like to thank you again for joining us today. I'd like to invite you to see the library of our videos of our webinars on our YouTube channel, and I will turn the program back over to Amber to close this out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, July 5th, at this same time. Next month's webinar will be titled Trustees' Obligation to ILIT Beneficiaries. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.